Welcome to this Explainer. Today, we are going to dive straight into the hidden machinery and, honestly, the absolute heavy lifting behind a company going public. We all see the confetti falling and the founders grinning, ringing that bell on the trading floor, but how does a private company actually transform into a publicly traded powerhouse? Well, we are dissecting the massive 15-phase construction project of an initial public offering, and we're looking really closely at the master architects who actually build it, the investment banks.
All right, let's just quickly glance at our blueprint for today. We're going to move chronologically right through the IPO life cycle. We'll start behind the curtain, move into preparing the blueprint, underwriting the risk, the pricing roadshow, and then finally launch day and beyond.
Okay, Section 1, behind the IPO curtain, the illusion versus the reality. When you see those founders celebrating on Wall Street, you're really just seeing the glamorous finale. You aren't seeing the grueling foundation that took months or sometimes even years to pour.
Which naturally brings up a very logical question, right? Why can't a successful, highly profitable company just sell its own shares directly to the public? Why do they absolutely need to hire a pricey intermediary to do it for them?
Well, the reality is that going public is an entirely different beast than simply running a good business. Most companies just simply lack the internal expertise to clear all these hidden hurdles. We're talking about incredibly strict regulatory compliance, super complex financial reporting, investor marketing, share pricing, and just a literal mountain of legal documentation. This is exactly why giants like Goldman Sachs, Morgan Stanley, or JP Morgan have to step in. They act as the master architects because they have that highly specialized expertise accumulated through hundreds of successful transactions.
Moving on to Section 2, preparing the blueprint, laying the foundation. Because look, before a single share is ever sold, the investment bank has to figure out if the corporate foundation is actually strong enough to survive the brutal scrutiny of the public market.
If you look at the macro timeline, right now we are squarely in the initial planning and readiness phase. During this chunk of time, the bank is ruthlessly evaluating the company. They're looking at financial performance, the business model scalability, and corporate governance. They have to make sure that everything, from internal controls to international and domestic accounting standards like IFRS or US GAAP, is absolutely flawless, no exceptions.
And as part of that strategy, the bank also has to decide exactly what is being sold. This is absolutely crucial. Are we selling primary or secondary shares? Primary shares are newly issued, which means the cash raised directly into the company's treasury to fund growth. Secondary shares, on the other hand, that's just existing owners selling their personal stakes, meaning the company itself receives zero proceeds. It's a massive strategic decision, and it signals a whole lot to potential investors.
Then comes the billion-dollar question. What is the company actually worth? To figure this out, investment banks definitely don't just guess. They run multiple insanely complex models all at the same time. They project future cash flows with discounted cash flow models, they compare price-to-earnings ratios against similar public companies, and they analyze precedent transactions. But here's a really surprising fact for you. Sometimes valuation relies almost entirely on current market demand and investors' sentiment. I mean, literally, two identical companies can get wildly different valuations just based on the market's mood that particular month. It's wild.
Let's jump into Section 3, underwriting and assuming risk. This is the high-stakes guarantee. Underwriting marks the exact moment the bank steps out of a purely advisory role. This is where things get very real. They formally commit to selling the shares, and often they actually purchase those shares from the company first. So they are putting their own money on the line and taking on massive financial risk.
Now, there are two main ways this happens. Depending on the deal, the bank either guarantees the sale through what's called a firm commitment, where they purchase all the shares and take on all the risk themselves, or they agree to a best efforts deal. That's exactly what it sounds like. They just try their absolute hardest to sell the shares, but if they fail, the unsold shares and the risk remain completely with the issuing company.
In a firm commitment, which, by the way, is the most common for large IPOs, you can see how the risk transfers. It goes from the company straight to the investment bank, and then, ideally, to the public investors. But, and this is a huge but, if the public investors decide they don't want to buy those shares, well, the music stops squarely at step 2. The investment bank is left holding the bag, owning all of those unsold shares. Because the risk of unsold shares, volatile markets, or even legal liabilities from inaccurate disclosures is so immense, one bank rarely goes it alone on a big IPO. Instead, they form a collaborative syndicate to share the burden.
You've got the lead left book runner coordinating the whole show, and they're supported by joint book runners, co-managers, and selling group members. These guys all help distribute the shares across a massive network of investors without taking on the direct underwriting risk themselves. It's really a team effort.
All right, Section 4, Pricing and the Roadshow, the high-stakes sales pitch. So, the blueprint is approved, the prospectus is written, the risks are assumed by the syndicate. Now it's time to actually sell this thing. Senior executives and bankers literally pack their bags and travel to pitch major institutional investors. We're talking mutual funds, pension funds, hedge funds, the big players.
During this roadshow, the banks are doing something called book building. They are carefully recording exactly how many shares Fund A, Fund B, and Fund C want, and the absolute maximum price they are willing to pay. This real-time data is critical. It's how they gauge exactly how much market demand exists at specific price points.
And the crucial point here is that this order book dictates the final IPO price. It is a ridiculously delicate balancing act. If the syndicate prices the shares too high, investors will just walk away and the IPO fails. But if they price it too low, the company leaves millions of dollars on the table that they desperately could have used for growth.
Finally, Section 5, Launch Day and Beyond. The price is finalized, shares are strategically allocated to high-quality institutions to create a nice, stable shareholder base, and trading officially begins on the exchange. The founders ring the bell, everyone cheers.
But wait, the architect's job actually isn't over at the opening bell. Immediately after listing, share prices can get extremely volatile. To counter this, banks act as stabilization managers using tools like the Green Show option. This is brilliant. It allows the bank to sell or buy an additional 15% of shares. If demand is too hot, they exercise the option to inject more shares and cool the price down. If the price starts falling, they actually buy shares back in the open market to forcefully stabilize it.
So for orchestrating this massive high-wire act, how are investment banks actually compensated? Well, their underwriting fees scale inversely with the size of the IPO. A small IPO might carry an 8% fee, while a mega IPO is usually under 2%. But honestly, the math adds up incredibly fast. Think about it. A $1 billion IPO with a 5% fee? That generates $50 million in fees, shared among the lead underwriters and the syndicate members. Not a bad payday.
Which brings us to the real takeaway here. Investment banks are not just intermediaries, simply selling shares. From assessing a company's readiness to building complex financial models, marketing to hedge funds, assuming massive financial risk, and even stabilizing post-market prices, these institutions are the true, indispensable architects of the public markets.
And that leaves us with a fascinating final thought to ponder. We place so much focus on the stock exchanges and the flashy startup founders. But if the public markets require this much hidden, highly specialized architecture to function properly and safely, could the modern stock exchange even exist without investment banks? It really highlights the immense behind-the-scenes power these institutions hold over global finance. Thanks for joining me on this explainer. I really hope this gave you a whole new perspective the next time you see a company ringing that opening bell.